You may learn about investing and how to make the best financial decisions for your life on Investor Facts. Make sure you click the subscription button and enable the notification bell if you haven't already. Share, like, and comment. The greatest trading concept of the decade may be Alibaba, and this stock study will analyze the company's operations, along with its advantages and disadvantages, financials, and valuations. According to my price forecast, Alibaba is currently one of the best plays. Alibaba, a Chinese business, is currently traded on the New York Stock Exchange as an ADR, or American Depository Receipt. The management aims to list the company twice at Hong Kong Stock Exchange. This should be emphasized. They are one of the largest e-commerce enterprises in the world, concentrating primarily on Asia and China. Consider them the Chinese Amazon. So let's discuss Alibaba's advantages. Alibaba is benefiting from a number of long-term megatrends, including e-commerce and the continuous expansion of emerging markets, both of which are expected to last far into this decade. The most crucial aspect of an investment in Alibaba is e-commerce for developing nations, and those transactions must be successful. However, cloud computing is another major trend. If Alibaba can maintain its market share in this expanding industry, it might be a game changer. Almost all Chinese tech companies have been subject to harsh CCP rules, and Alibaba, in particular, has come under fire. The former CEO of Alibaba, Jack Ma, whom the party perceives of somewhat of a renegade who undermined social ability and party rule, is to blame for this regulatory onslaught. He lambasted the CCP for initiating this severe crackdown. Remember that China is essentially a totalitarian regime, which makes the business climate at best unstable and at worst completely uninvestable. The primary risk associated with investing in Alibaba is this: before making an investment, extensively research the political and economic landscape in China. Clearly, Alibaba would not benefit from this. Revenues are shown at the top, or the top line, and profit, often known as earnings or the bottom line, is obtained by deducting firm expenses. With top-line revenue now standing at $127 billion, it is clear that this figure has been rising for a number of years. However, the company is currently reporting its first revenue fall in 2022, and the most recent quarter showed flat growth. From the previous $23 billion only a few years ago, net income has decreased by roughly 75% to only $6 billion. This signifies that Baba invested in a company whose book value has since decreased, which is recorded as an expense. The liabilities, or what is owed to others, are always equal to the shareholders' equity, or what the shareholders own, plus the assets. Let's start by examining how Alibaba's assets and liabilities are related. Their liabilities total about $92 billion, which is a very small portion of the enormous $250 billion in assets. About $60 billion of that amount is in cash and short-term investments. Their net debt is actually negative $41 billion, indicating a surplus. With a market cap of $170 billion, that means that about 25% of the corporation is cash that is available for use or distribution. Prior to moving on to the cash flow statement, I should point out that we can also observe that Alibaba's book value per share has been rising, and that their shares outstanding are somewhat declining, which indicates they are purchasing shares. The cash flow statement is the last part of the financials. It demonstrates how money simply enters and exits the company. It is frequently thought of as providing a more accurate picture of whether the company is profitable or not than the income statement. Cash from operations, or the money the company receives from regular activities like sales, and CapEx, or capital expenditures, are the only two crucial figures I keep an eye on in this context. Cash from operations increased year after year from $20 billion in 2018 to $35 billion in 2021. CapEx has been rapidly increasing, which is not surprising given the previously mentioned collapsing net income. As a result, less money is flowing and more money is being spent on running the actual firm. This figure we'll use to determine Alibaba's intrinsic worth and to determine a price forecast. From about $30 billion in 2021 to around $11 billion today, free cash flow has plummeted. This is a representation of Alibaba's business. Sales are represented by the first four measures. Over the past 5 years, Alibaba has grown at a compound annual growth rate of 26% every year. Given the already enormous size of the business, it is even more astonishing. The overall sales score is only 35 out of 100, which is pretty low. In contrast to today, the return on the equity has dropped from 19% in 2020 to just 2%. The debt-to-equity ratio, also known as the risk ratio, measures the business indebtedness and is absurdly low at 0.16. Alibaba even has a net debt that is approximately negative $41 billion, or almost 25% of its current market value, as we can see from the balance sheet. The final three measures examine whether Alibaba returns any money to its shareholders through a dividend or a share buyback. Alibaba does not currently pay dividends, and I don't anticipate them to do so anytime soon. For the next 10 years, that equates to an average growth rate of 6.8%. The average growth rate for the decade is around 10% in the usual case, which is the one I feel to be most likely. In the best case scenario, I use 13.5% growth. It should be noticed that this is far less than what Alibaba had in its heyday and less than, for instance, their American equivalent, Amazon today. However, given the drastic change in China's investment climate, this is regrettably well deserved. If you want to, pause and look at the numbers. The IRR would be 22% on average per year, which is a phenomenal return comparable to the figures most super investors have. My calculations indicate that, in the best case scenario, the stock price today is extremely undervalued at $180. Other sources such as Wall Street alone value Alibaba at $143, while TopRank values it at $144. If we additionally take into account price ratios, such as our price per sale of 1.3 and our price per book value nearly 1, I am confident in saying that this company is significantly undervalued. If you're not okay with the high risk and great unpredictability, it still might not be a viable investment. Don't be afraid to sell your stocks if you don't think they will go up in value. This is a very important part of making money in the future market. Thanks for watching the entire clip. If you like it, kindly let us know by hitting the like and subscribe buttons. Also, don't forget to enable the notification bell so you can be the first to know when we post a new video. In the following video, I'll see you. Goodbye.